Then you've got availability of funds, which refers to the ease with which a business can access funds for borrowing on the international financial markets. So what's available now is that instead of just, going to Commonwealth, going, to your normal Australian bank to borrow money, a lot of businesses actually go to overseas banks and, very international big banks to borrow money from international institutions, companies, so that they can raise their capitals. Now, conditions and rates obviously apply and they depend on the risk, demand, supply, and domestic economic conditions. So, for example, there was the global financial crisis in 2008 to 2009, which had a major impact on availability of funds for companies, and it led to a sharp increase in interest rates, which reflected the high level of risk in lending. So, let's say you wanted to buy from for example, a very big bank in Switzerland, that bank actually had higher interest rates and even higher level of risk in lending because the economy globally was in absolute shatters. So, availability of funds really has got to do with the just the possibility and how easy it is to access funds at different times. It's easier or harder. So, for example, since the global financial crisis back then, supply has been lower in Australia and overseas for Qantas because a lot of financial institutions closed and the lending criteria is a lot stricter. And that actually led to reduced profits for them in 2014 because they couldn't access as many funds as they wanted to, and their credit rating was higher for a lot of banks, so it meant more interest for Qantas, which means that they're losing more money because they are paying more interest. Because again, interest is the cost of borrowing, and we want to achieve profit maximization. So if you're paying interest and it's a cost, it's affecting your profit. Now, the last one is interest rates that affects the global economic outlook. Interest rates is just the cost of borrowing money. If you want to go to Commonwealth, you can't just go to the bank and be like, hey, can I have 10K? Like, yep, here's 10K. Because where do they get their money? Like I said, every single business wants a profit at the bottom line. So interest rates is that extra percentage that they add on, and that's how banks make their money. So the high level of risk in lending means a higher interest rate. So what a lot of businesses will do, they'll actually relocate offshore or they'll expand domestic production facilities to increase direct exporting, which means they need to raise finance to undertake these activities. So this is where businesses will, instead of producing their products in Australia, a lot of the time they go to third world countries, or countries with laws that either no laws or very kind of lenient laws, and not even low key, very high key, unethical laws where they're not paying workers enough at all. And they're going to those countries because if you have to pay, for example, minimum wage here, which for an 18-year-old, it's like $19, for example. If they have to pay $19 an hour for like an 18-year-old to work here, and they can go to China, for example, and you've seen those Nike documentaries, even the Sheen documentaries, and they're barely paying them $2 for a whole day's worth of work in horrible conditions. Ethically and like their social responsibility, that's so low and so disgusting. But from the business point of view for them, moving that overseas is such a cheaper option for them in the long run because they're not paying those wages and they can get the same end product for a much cheaper price. But again, to be able to move it, to be able to build those factories, it is a big cost initially, and they need to raise that finance, which is why a lot of them will go to overseas banks because they can get over some money advantages. So Australian businesses, you might be thinking like, oh, why wouldn't they just borrow from like an Australian business? Like, why not just go to St. George? Why not go to Westpac? Like, why would they need to go to an overseas source? But different economies have different dollars and different values. So I'm sure you guys have seen the news, or even like you guys would know, like if you go on to, oh, what's that shoe store? Well, when you go to buy like shoes online, and like you might see like a really nice pair of like Dunks or something, and it's like 150, and you're like, oh, that's mad, but it's actually like 150 US, and realistically, like it's over $300 in Australian dollars. That's because there's different values of currency, and it's all like got to do with exchange rates. But this comes into deal with businesses as well because sometimes the exchange rates are actually better for us when you go shopping overseas. So I know for me, when I went to London, I went to like Harrods there and I saw like this really nice pencil case. It was like £20. And I was like, oh, like mad. but it actually ends up being like double that. And same with like the euro. When I was in Europe, I was like, wow, this is like so nice, this is so cheap, but like everything ends up being nearly double because of the exchange rates. Now in some countries it's actually cheaper for us to just shop here, especially with Europe. It's much more expensive for us to shop there. And when you're transferring the dollar, same with like the US dollar. um it's cheaper for us to just buy it like in terms of like Australian dollars. But in other countries, especially when you're going to third world countries, and a lot of Asian countries, the dollar is actually cheaper. So, for example, the yen, and there's actually more benefits in you buying it from over there. So, what a lot of what a lot of customers and businesses are doing now, they're actually going overseas to borrow from those banks because they've got lower interest rates. So, they're actually getting the same amount of money for cheaper because they'd have to pay higher interest here. But the problem with that is that if the exchange rate goes up over there, for example, you're borrowing from China, maybe they have like a 2% interest rate, but here it's a 5% interest rate, you're obviously going to save on that 3%. Let's say, for example, their exchange rate actually goes up though. Because the exchange rate goes up, so does the interest rate. And then that can actually mean that that cheaper deal actually becomes even more expensive because the currency has fluctuated, which means that cheaper interest rate is completely eliminated because the dollar's actually gone up. So again, it's a risk because you're borrowing overseas and you never know with currency and fluctuating. Every single day it's on the news and it's changing all the time. Depending on the conditions, depending if there's war in that country, depending on the government at the time, it can always affect that.